Hi folks, nearly 12 million people will be filing and expected to file a personal tax return by the 31st of January 2021. That's the focus of what we're going to be talking about today. My name is Mahmood. I'm an accountant and educator by trade, profession, skill set and experience. My business of the 25 years plus has been about helping overwhelmed business owners make money, save time. That's got to be a pretty cool thing by using their numbers and my expertise. So regarding today's show, if you catch up, by the way, let's do a bit of housekeeping. If you're coming on the replay, fantastic. Thank you very much for doing that. Put in the hashtag replay. I'll know you guys are out there. If you've got comments that you want to share, questions that you want to ask, feel free to put them in there, and I will do my level best to answer them during the broadcast as well as after. Now, more importantly, let's get on with the broadcast. Let's get on with the show. And what I'm going to do, by the wonderful world of magic, if this can happen, bring this into the stream. Let me just focus first of all, everybody, about what is it we're going to cover in this short broadcast. So the presentation content. I'm going to avoid death by PowerPoint, but it's usually pretty cool for me to have this here, so make sure that I don't go off at a tangent and start talking about other things here. We talk predominantly about that tax return filing. Can be a pretty much anxious and stressful time for many people. Some people, selves included, have already filed tax returns for clients. Some of you may, as is common, leave that till much later. We've got about 6 months to go. So this is going to be full of practical takeaways, give you an overview about how the system works, what your part is, whether you even need to involve yourself, and this is what we're going to cover. So effectively, if this can work, he says, just talk amongst yourselves for a second. There we go. So first of all, we're going to talk about who needs to bother. So I said 12 million people will be completing a personal tax return by 31st of January 2021. That's about 30% of the UK adult population. So we need to focus on, how do you know you're one of those 12 million people? So not everybody in the UK will have to complete one, but certainly we need to look at the conditions and criteria. We're then going to look in terms of what is actually needed to complete a tax return. And when I say what is needed, what is it we've got to gather? So when that time comes, preparation, there's an expression here that says about, I won't be too expletive here, about proper preparation and planning prevents piss poor performance here. So if we gather all that information together and we know what we need to get hold of, then it's going to make the process much less painful. See some people already coming on the live. So say hello to Anna, who's just turned up. So morning to you. Let's get back here. We're going to talk about what you can claim. So if you are self-employed, and that's got a particular meaning in the context of personal tax returns, I'm going to share with you what you can claim. It's a common question I get asked is, can I claim for X? Can I claim for Y? I'll give you a rundown of what the general strap lines are. How do you know whether you can claim it or not? And I'll also share some tips about how you can sort of maximize those claims, and obviously why you need to claim in the first place. And lastly, the interesting thing is deadlines. All tax systems always work on this basis of, you've got a responsibility as a taxpayer, make sure it's done by this time. If you don't do it by that time, it's more than a slap on the wrist. It's probably a fine that's going to follow. And obviously, if you've got money to pay over to HMRC, then we need to know what those deadline dates actually are. So morning to Anna. Anna, hope you're well. Just joined us here. So again, if you're coming up on the replay, then that's fantastic. Put in the hashtag replay or hashtag live replay. I'm not quite sure what it is. And then I can track where you are, and then we can actually follow that up accordingly. So let's move on with the presentation. That's the 4 areas we're going to cover. So first question really is, do I need to actually bother? Now, I would like to give a bit of a caveat here. There are a number of clients that I deal with, a number of people I come across, and what happens is after the end of each tax return season, HMRC will look at all the information that's been gathered, and they will make a decision, and they will send out letters to lots of people saying, according to our information, you don't actually need to bother for next year. But there is a lot of small print that follows that. So even though you may have filed a tax return before and HMR send you a letter saying don't bother, what they're actually saying is, actually, if these circumstances remain the same, then fine. But actually, you still have got a responsibility to file if you meet these conditions. So who are these individuals? And we are talking predominantly by the individuals here. So companies, limited companies, this does not apply to your company. This relies and applies to particularly to individuals as such. We're talking about the year, what we call 1920, very peculiarly that runs between the 6th of April 2019 and the 5th of April 2020. And it's focusing predominantly on what's called income and gains. So who are the individuals who need to bother? Self-employed. Now, self-employed in the context of what we're talking about today has a particular meaning. So myself, other people that I know, when you talk about self-employed, you're talking about being your own business owner. You're talking about running your own business, whether that's through a company, whether you're talking about as a solopreneur. We're not talking about self-employed in that context. We're talking about somebody who runs their business as a sole trader, it might be called. Somebody who runs their business, they might call themselves a freelancer. You might call yourself a solopreneur. So it's about self-employed. And the key thing is, if you're generating more than £1,000 a year from self-employment, then you're in the net. You have to declare that. Declaring it, by the way, doesn't mean you pay tax. There are two sides to this conversation with HMRC. Number one, the document, the tax return that has to go in. And then number two, do you owe any tax as a result? So completing a tax return doesn't necessarily mean that you owe tax. So there are two, if you want, separate obligations. So if you're self-employed, a solopreneur, a freelancer, anything along those lines, and you're generating more than £1,000 a year from income, then you've got to register and submit. Number two, if you're what's called a higher paid employee. So if you're in a full-time job or part-time job and your income collectively is more than £50,000 a year, that's the definition of higher paid. Now, here's the other thing. If you've got a job and your income, salary, benefits is more than 50k a year, tick box, you're a higher paid employee. Now, the special thing is, if you have any other income from other sources, so you might, for example, have a rental property, you may have a part-time side hustle, then you're in the net and you've got to prepare and submit a tax return. If all you've got is PAYE, well, say all you've got, plus say benefits like company cars, medical insurance, that will typically be taken care of through the PAYE system, then you can relax and don't have to worry. Number three, company directors. Now, this applies across the board, by the way, everybody. So you can be a director of a social enterprise. You can be a director of a private commercial company. You can be a director, brackets trustee, of a charity. Typically, in the main, what we're talking about here is if you are a company director and you draw down income, the received wisdom is you have to complete a tax return, even if there's no tax due. If you are a director of a social enterprise, like maybe a not-for-profit entity, a limited by guarantee, and you're not drawing any income, then you don't have to prepare and submit a tax return. My advice would normally be, by the way, if you happen to be a director of a social enterprise and you're not drawing any income, I would probably just mention that on your tax return, saying, by the way, guys, I'm a director of this entity here. So even though there's no tax liability, I would probably disclose that as a note in your tax return. So that's three categories, three types of situations. Self-employed, higher paid employee. The magic mark for 1920 is 50k a year, and you receive income from other sources untaxed. Company directors. Now, if you're also a higher earner, now whether it feels like it or not, a high earner is classified as 50k, and either you or your partner are claiming child benefit, then you have to complete a tax return. So if you're receiving child benefit and your income is say 30k a year, and your partner's got an income higher, say 50k plus, your partner will have to complete a tax return. If both of you have got an income of about 45k each and you're claiming child benefit, rightly or wrongly, you don't have to complete a tax return and you can keep the child benefit. Now, this is often left out by individuals. So if you're a solopreneur and you've made losses in your business, which is not necessarily, it happens to all of us. When I started my business career 25 years ago plus, in the earlier days, in the earlier years, as the business was building up, as I was trying to establish myself, the income was quite modest. It was quite pathetic, really, in relative terms, but the outgoings were quite high. That business made losses. If you've got a rental business and you're just starting up and the rental income is quite low and the outgoings, say typically on the mortgage interest, any costs of repairs, that's such that you make a loss, you need to complete a tax return for two reasons. One, if you don't, then you run the risk of losing out of any potential loss relief. So loss reliefs are typically time bound and you have to make a claim. And when it says make a claim, you typically do that in your tax return. So if you've got a loss from a property business, if you've got a loss from your sole trader business, your self-employed business, if you wish to claim that loss in a particular manner, then you've got to complete a tax return and register those losses. They are time bound. As an example, if you happen to be self-employed and you've made losses, there are many ways you can use that loss to your advantage. If you wish to use them against anything else you've got going on in this current year or in the previous year, you've got effectively a 12-month window after your tax return deadline in order to claim those losses. Otherwise, you've lost them in terms of that particular route. And lastly, now strangely, a personal tax return, by the way, relates to the individual. So if I'm completing a personal tax return for myself, which I will be, I have to declare in that box what's my income from a variety of sources. I will also, if I've engaged in any what's called selling shares, selling second properties, selling major works of art, any what's called capital, that also has to be disclosed in the personal tax return. If you're merely moving house, you're selling a home, you've never rented it out, you've not got another property, that's cool, you don't have to worry. But anything like capital based, like buying and selling shares, buying and selling works of art, antiques, second properties, you have to declare that and you have to therefore complete a personal tax return. So that's the first thing. Make sure if you're in that list, then it's likely you're going to have to complete a personal tax return. Does it matter? Well, unfortunately in the UK and all tax systems around the world, if you don't comply, you'll get a slap on the wrist followed by a financial penalty as well. And obviously that's an avoidable situation, so we certainly don't want that. Now, in the beginning. So this is what I would strongly recommend that we think about at the beginning of the process here. So let's think about, first of all, visualize what the tax return consists of. So whether it's done electronically or whether it's done in a paper version, and paper versions are still acceptable, then there are two main elements that make up the tax return. There's called the core return, and then there's extra bits to add on to that. The official terminology in the world of HMRC and tax professionals is called supplementary pages. Bit of a mouthful. So what we're talking about is you've got a basic 8-page document, and then you've got an extra lot of pages depending what your other sources of income are. Now, what does the core return involve? Well, typically it would involve who you are, name, address, national insurance number, something called a tax reference, which we'll deal with in a moment. It would also ask you for, things like, are you claiming child benefit, things like student loan. This is information that effectively affects every individual here. So it's the same basic questions that will be asked. It looks top heavy if you're not used to it, by the way, first time round. Remember, they've designed the return to cover everybody, so there will be questions that are not applicable. When it was first introduced many years ago, self-assessment, the questions were you had to tick yes or no. Now HMRC have taken a policy that if it does apply, you tick the box. If it doesn't apply, in the main, you just ignore it. But obviously read it carefully. The next thing I would suggest is once you've got an idea what situation you're in, so, are you self-employed? Do you have rental property? Critically, the one piece of information that's absolutely vital is your tax reference number, what's called your UTR. If you don't have that, effectively, you're not going to be able to file the return. And if you don't file the return, you obviously will get fined. You can claim it, you can request it back. If you haven't registered, by the way, then obviously what we said from the previous slide, make sure you get your shit together, get your act together, and actually register. Apologies for that little faux pas of swearing. So gather what you need. So if it's accounts you need, get them prepared. If it's things like tax that you might have already paid, go onto either your gateway account, check out what you paid the previous year. So gather all the information, make sure your rental accounts are up to date, make sure all those figures are done, because the actual processing of the return is quite straightforward. It's putting numbers into boxes. That seems quite straightforward, doesn't it? But it's like any form of preparation. If you wanted your house decorated and you want it decorated well, half the battle is in the preparation, making sure the walls are nicely done, making sure that there's no chips, make sure it's smooth. The prep is vital to the actual final execution. So gather all that information together. Supporting documents that you might need. So what do I mean by this? So typically, let's assume a taxpayer is employed. So they've got a job, part-time or full-time. Let's assume they've also got maybe a pension they're receiving. Maybe also there's other situations here that they've got, let's say, some savings certificates, whatever. Well, the documents typically would be a P45 or a P60 if you're employed. If you're also employed and you've got, for example, let's say benefits like medical insurance provided, a company car, a company yacht, that would be a wonderful thing, obviously. Then look back, because you need things like reference numbers to come off those documents. HMRC love reference numbers. And if you don't have those reference numbers, like your PAYE reference, you won't be able to file the document. So this is not so much the tedious bit, but gather it all. Now, if you are somebody who does your own return and you're familiar, fantastic. There might be some gaps in here that you need to consolidate. If you hand that over to somebody else to do that, typically, by way of illustration, we would typically send out a checklist to clients to say, when you send your information here, typically this is the sort of things you'll be expected to gather. And it accelerates the process, also has an impact of how much time it takes, and it also means it gets done more quickly, and hopefully there'll be a benefit in terms of time and cost as well. Estimates. Now, it's quite possible, and I've met this over 25 years here, is that people say, well, I know I actually spent this money in my business. I'm not quite sure how much it is. I've lost the receipt. I've lost this here. The rationale behind personal tax returns in the UK and pretty much around the world is to say it's the taxpayer's responsibility to make a declaration of their income and or capital gains. That's the posh way of putting it. What it then says is, in certain situations, it is possible to make a reasonable estimate of what you're putting into your tax return. Now, that reasonable estimate can extend a number of ways. When we look at the self-employed section later on, we're going to be looking at expenses that are incurred, which have basically what's called a dual purpose. Some of it's for your own business, and some of it's for personal. So how do you figure out, what is what? What's the split? Well, you can make a reasonable estimate. Also, I've seen situations where somebody knows they've gone to a client meeting, they've spent money in that travel, they haven't actually got the receipt, and it's like, well, how do I figure out what that is? I know I've spent it. Well, I would suggest you can do things like look at your calendar. If you travel by car, look at your calendar, tot up mileage, for example, and then you can work out what the cost of that travel has been. So you are allowed to use reasonable estimates to come up with those numbers. Obviously, background evidence, whether it's email trails or something, will be very useful. Now, let's focus on, everybody, the self-employed. Now, by self-employed, we mean specifically in this context, if you run your business as what's called a sole trader, you run your business as a freelancer, you run your business as a solopreneur. You can have other business interests, but we're talking self-employment in respect of that particular description. You'll know what it is because if you've done a tax return before, you normally have an orange section here for your self-employed pages. So this is what you can claim. The rules for companies, by the way, are similar, but there's a completely different ball game here. So we're focusing on the self-employed, the sole trader, the freelancer, the solopreneur, the independent contractor, however you wish to describe yourself. So we're not talking about companies. Typically, this is what you can claim. The rules are, and I always think it's good to start with a strap line. So what's the overarching strap line for what you can claim? And I always tell individuals and clients, when you look to see what you can claim, two things. You've got to ask yourself, has that expenditure been incurred, i.e. have you spent it in respect of it's wholly and exclusively for your business? Does it have a business purpose behind that? Let's think about a contrast. If I spend money going on a holiday, okay, to recuperate, re-energize, rejuvenate, then obviously that's going to have a business benefit because it makes me fresh, it maintains that well-being. But the primary purpose of that trip is a personal, it's a social, it's for myself. If I happen to meet a couple of clients along the way, that's fine, but that's not the primary purpose of that expense. Therefore, it's unlikely I can claim any of that holiday spend. Now, if I happen to spend money on, let's say, promotion, advertising, social media, if I happen to spend money in terms of visiting prospects, all of that is business related, that's cool. Now, if it's somewhere between the middle, so typically it's things like telephony, I've got a mobile phone perhaps, and those calls, some of it are personal, some of it are business, well, then I'm allowed to make a reasonable estimate and split that between the two boxes, between how much is personal, how much is business. I will emphasize, as I said, these rules are not the same for limited companies. I'm going to have a future broadcast where we're going to have a trip down what happens for limited companies in this arena. So business cost is going to be for business purposes, effectively. That's the primary rationale behind the spend. Now, this is what we meant by shared expenses. So typically, if we think about a sole trader business, you will be spending money on a combo. Some of it will be purely business, so advertising, social media, subscriptions you might have to your, say, your software, your website, fees that you might pay to your accountant, obviously. So some of that will be purely, effectively, business related. That's fine. Some of it will be shared. So the most common arenas are perhaps your telephony costs. So that cost is effectively combo between personal use and business use. You are, for sole traders by concession, allowed to make a reasonable estimate of what proportion relates to business and what proportion relates to personal. The personal, unfortunately, you can't claim. Your business can pay for it. There's no problem with that. But for tax reasons, you can't claim it. Other things might be for things like travel expenses, like motor cars. And I'm going to deal with that specifically in a subsequent slide. But if you're claiming the cost of running your vehicle, so the cost of petrol, car tax, insurance, and so, etc., then you might decide that actually of the journeys that I'm undertaking, maybe 60, 70 or 80% is business related and 20% is personal. And that's what I call shared expenses. So where you spend money that's split between the two arenas, then you are allowed to make a reasonable estimate of what's there. Again, what I would do, evidence and records are really pretty cool. So if you've got the ability to make a note somewhere of how you reached your conclusion, just in case HMRC ever come back to you and say, okay, tell us how you managed to get those numbers there. Capital purchases. Now, what we mean here, we met the term earlier. If you're spending money on things like computers, if you're spending money on things like cameras, certainly in the world of social media that we face now, you're spending money on equipment, you're spending money on microphones, the whole works there. Any equipment that you use in your business, if you're a sole trader manufacturer, that's a capital purchase. You can claim that, but there's a different set of rules for that. So typically, as a heads up, as a general rule, if it's a capital item like equipment, computers, software, perhaps PCs, laptops, whatever, you can claim all of the cost immediately. Whether you should do or not is a different consideration, but you are allowed to claim 100% of the cost. It may not always be the best thing to do for tax purposes to claim all of it. Entertainment. Now, if you entertain, now in the business environment, we always have to build positive, good relationships with clients. You know, it's got to do that. So those occasions might be that you meet a client, perhaps you buy them lunch. Well, if you might have a group of customers that are very important to you. You might be doing some schmoozing with them. And that sort of expenditure, unfortunately, even though it's commercially a necessity to actually keep that client relationship going, you can't claim it for business purposes. However, within that, if you've got things such as an overseas customer, perhaps, overseas customers, believe it or not, are exempted, you can claim for that. It also applies to entertaining suppliers. You want to keep that good, positive relationship. You can't normally claim for the cost of that entertainment. If you employ a team, by the way, so you've got a team under PAYE, then you can claim for the cost of that staff entertaining. There is a limit that's capped, but you can still claim for staff. But generally speaking, customers and suppliers in the main, unfortunately, the computer says no, there's nothing you can do in that respect. Let's come on, what's the next slide? Now here's a regime, again, this is specifically for sole traders, solopreneurs. The second criteria is you've got to be below what's called the VAT threshold, below 85K for most of them. So typically, this is for, I'm going to look at two areas here, which is called simplified. And it means simplified, by the way, because it means you don't have to worry about finding receipts. You don't have to worry about finding the proof of it in the sense of where's that piece of paper. And I'm going to look at two key areas here. This is for vehicles and for working at home, and it applies to sole traders and to partnerships. It does not apply to limited companies. Now, transportation. If you've got a car, the options you've got when you run a car and you've got a sole trader business here, you either claim the costs of running the vehicle, adjusted for personal items, or you claim a flat rate on business miles travelled. Typically, it's 45 pence for each business mile travelled. Doesn't matter what the engine size is, doesn't matter whether it's diesel or petrol. And then after 10,000 miles, you can claim 25 pence per mile. If you've got a bike and you're using your bike to commute, a motorbike, you can claim a flat 24 pence for each mile. That covers, by the way, the cost of the fuel, the cost of the car tax, the cost of insurance, and the cost of purchase of the vehicle as well. It doesn't cover things like breakdown cover, but it covers the normal running costs. It obviously covers business mileage. So if you're based at home, so your base of operation for your business is at home, that's fine. If you've got a separate office, technically speaking, traveling between your home, your personal home, and your office does not count as business travel in the main. So therefore, that won't be included. But if you've got a home base, where that's your operational base, and you travel somewhere, whether it's to see your accountant, whether it's to travel to see a client, whether to travel to a trade show, whatever event that's going on, that's business travel, you can claim that. Now, be very careful here. Once you make a claim on a vehicle for mileage, then you cannot change it for next year if it becomes better. The only time you can change the method going from mileage to actually looking at the actual cost of running the car is when you sell the vehicle or get rid of the vehicle. So if you buy a vehicle, say in 1920, you decide to claim a mileage rate, next year, you cannot go back to a better option for you, is like look at the actual expenditure. So if you've had massive repair bills, for example, you only can change it when the vehicle changes itself, or you sell it and get a new one. And push bikes, by the way, if you use a push bike in your business travel, you can claim 20 pence for each cycle mile that you've done. Obviously, it's much better for the keep fit option, so those options are there. Now, it's not uncommon for solopreneurs, sole traders, businesses, whatever shape, to work at home. And you can claim for the costs of using a home space as your office. Now, there are two choices here. There's a flat rate that says, how many hours on average are you working on your business, in your business, from home? If it's between 25 and 50 hours per month, you can claim a flat rate of £10, and you don't have to worry about bills, look at the costs. I'll talk about the alternative route in a few moments. So on number of hours guides the amount you can claim. If you work between 51 and 100 hours per month on average on or in your business, so whether it's social media, whether it's actually doing the client's work, whether it's sending out tenders or proposals, you can claim £18 per month. And the most generous one is if you're working in excess of 101 hours per month, then you can claim £26 for each calendar month. Little slip of water there, apologies. Now, the alternative to the use of home, by the way, if you decide you don't want to claim a flat rate because you're spending a lot more money at home, then what you typically have to do is to add up the costs of running your household. So typically council tax, what the utility bills are, don't include telephony costs. Add those up. You can include also, by the way, mortgage interest. A little bit more awkward in terms of what you have to do to avoid capital gains, but effectively in principle, interest, council tax, utility bills, add them all up together. And then you think about the space that you occupy in your house, and whether it's your kitchen table, whether you've got a dedicated space in your house that acts as an office, and think it's yourself. If I look at my space that I'm occupying, that's about maybe 5-10% of the entire household space, then you can claim 5 to 10% equivalent. So that's the two choices that you have. Now, I want to sort of wrap up now with, or come to the conclusion of the key dates. So again, if you're listening to this on replay, put in the hashtag replay. You've got questions that come from this, fire them in, and I will address them accordingly. Key dates. And again, if we don't be mindful of these key dates, then we're going to have a consequence, typically, in either missing a deadline and or getting fines, which is obviously what we don't want. Now, obviously, there's the first thing you've got to do from the beginning. You've got to inform HMRC, and that means obviously registering for self-assessment. Typically, you've got to inform HMRC within a time frame of when you become liable to be in the self-assessment tax system. Paper returns, online returns. But surprisingly enough, by the way, not everybody has to complete online returns, doing it electronically. I know the whole world is gravitating towards a virtual world in terms of paper is disappearing. But if you've got religious grounds for not wishing to engage with the internet, and there are groups of individuals, by the way, that are in that bracket, then a paper return is for you. However, if you're not exempted, you've got until 31st of October if you wish to complete your tax return by paper. And I've, again, got some clients who still want to do that. You fill in the document, pardon me, fill in the piece of paper, you've got until 31st of October. If you miss that deadline, you've got to do it online. Online returns have to be submitted by midnight on the 31st of January 2021. So for the tax year 1920, which covers between the 6th of April 19 and the 5th of April 20, you've got until the 31st of January 2021 to submit your online return, and also, by the way, make any payments. Now, this is the fun bit, the payment. And as I outlined at the beginning of this broadcast, there are two aspects to HMRC. Number one is the part of HMRC that wants to get you to get your return submitted. So that's what's called like the assessment people, the ones who want to drag it in. Once their job is done, once your return has gone in there, they will deal with any issues arising out of the return. There's a separate section from HMRC that deals with the actual money, the hard cash, the collection side. Typically, it's under the umbrella of what's called debt management. Now, here's why deadlines are important. If you have a salaried position and you're paying your tax via PAYE, and you also happen to have a separate side hustle, additional rental property income, you might end up owing tax, and you may not be in a situation where you want to pay it all at once. You can collect that through your tax code, but you've got until the end of December 2020 to submit your tax return if you want it collected via your tax code. If you're purely self-employed, that deadline doesn't apply, but if you have got PAYE and you've got tax to pay, then you've got to submit it by effectively the end of December if you want that tax owing collected via your tax code. The second thing to consider, the actual deadline date for paying tax to HMRC is the 31st of January 2021. There are two things that could catch you unawares here that you've got to be really careful with. Let's assume, for example, somebody has got their first year of filing for 1920, they submit their tax return, the calculation says you owe under £800. That's fine. They pay the £800 by the 31st of January 2021. Job done, end of matter. They don't have to worry about giving money to HMRC until the following year. If it transpires, though, the tax that's owed, that's not being collected at source, is more than £1,000, that then triggers a secondary payment called a payment on account. It sounds weird, but it's effectively you giving money up front, an instalment, if you wish, towards the following year's tax bill. So if my tax bill was, say, I don't know, £2,000, it's my first year of filing, that means £2,000 goes to HMRC, no choice. I've also then got to pay another 50% of that at the same time for my next year's tax bill. So that's £3,000 that gets paid out. It's not all over. 31st of July 2021, I will have another £1,000 to pay out my second instalment for the following year's tax bill. So again, it can catch you unaware. You have the option, by the way, of thinking, actually, the following tax year is going to be a little bit more problematic. I don't think it's going to be the same level. So you can always reduce your payments on account. And that applies whether you're starting off in the tax system or whether you're long established. Now, it does happen sometimes that, it's either because we've not really thought about it. My advice normally to clients and taxpayers is when you start your business, your solopreneur business, you can pretty much guesstimate how much tax you're likely to pay. As a rule of thumb, depending on how much money you're earning, depending on what your other circumstances are, I would say cautiously, I would put about 15% of what you're earning away to cover your future tax bill. One of the things about self-employed individuals are that you don't pay tax as you go along each month. You pay them typically, once or twice a year. So whether it's 15% or 10%, I would certainly get into the habit of saying, I've invoiced a client for X amount of money. I put a proportion of that away in a separate deposit account to cover my future tax bill. So whatever that percentage is, and it's quite possible to work it out, put something away on a regular basis. You save it, it's not your money. You won't then be caught out short if you haven't got enough money to pay. But if you are in that situation where you can't pay, here's what you do. Do not be an ostrich. Do not bury your head in the sand. You need to confront it, I would suggest, and you need to deal with it. So again, HMRC are very flexible, believe it or not. HMRC are very receptive, and you can arrange a negotiation and a time to pay. So don't avoid it, because you'll get more fines, you'll get penalties and interest that runs, which obviously we don't want. You can arrange time to pay. And I would certainly say with the recent turbulence that we've had in the business landscape, HMRC have automatically deferred the July 20 payment on account till January 21. Just be aware, the July 20 payment that was delayed, if that's what the situation you found yourself in, is going to be payable by next January 21 latest. So if you haven't got enough funds, if business is challenging, you did your return late, you weren't aware that you missed something out, then contact HMRC, talk to their debt management time to pay unit. My experience has been that typically there's no issue arranging a time to pay for at least 6 months. You can get 12 months, and I have negotiated it where it's gone up to 2 or 3 years. But time to pay, you cannot negotiate time to pay, by the way, until you've submitted your tax return. The caveat as well, by the way, HMRC have more than 15 to 20 what I call external debt collection agencies who collect the money on their behalf. So if you do owe money to HMRC and you haven't communicated and you just put your head under the duvet, which is probably a natural reaction, remember, they will farm that out to private debt collection agencies who may not be as cuddly as HMRC are, if that sounds feasible. So remember, other debt collection agencies will be employed to collect that money on behalf of HMRC. Okay, folks, I hope you got some sense and value out of that session. So my name is Hamoud. I've really enjoyed your company. So again, if you've got any questions, come back to me accordingly. I hope you all have a fantastic rest of the week, and I'll see you guys later. Take care. Ciao.